Have you ever stared at a stock chart, trying to figure out that perfect moment to buy or sell? Well, when you do that, you're actually tapping into a legacy that goes back more than 100 years. Today, we're going to dig into the origin story of technical analysis. We're going to meet the trailblazers who first figured out how to turn raw market data into an incredible forecasting tool.
So what is technical analysis, really? At its heart, it's the art and, the science of looking at what the market has done in the past. We're talking price charts, trading volume, to try and predict what it might do next. It's a skill that millions of traders rely on every single day, and it all started with just a handful of brilliant minds.
All right, here's the game plan for this explainer. First, we'll meet the founder, the man himself, Charles Dow. Then, we'll see how his basic ideas got sharpened into a real predictive tool. After that, we'll get to the masters of the chart, touch on some big names that were controversially left off the main list, and then we'll wrap it all up with their incredible, enduring legacy.
And our story really does begin with one man, Charles Dow. Now, he didn't invent technical analysis as we know it today, not by a long shot, but he laid the absolutely essential groundwork that made everything that came after possible.
I mean, think about it for a second. Before Dow, how would you even track the market's overall health? It was basically impossible. By creating the Dow Jones Industrial Index and meticulously, day in and day out, recording its data, he gave all future analysts the raw material they desperately needed. He started to see patterns, an ebb and a flow to the market. But, and this is super important to understand, he only used these patterns to explain what had already happened. He wasn't trying to predict the future. Not yet, anyway.
So the next generation comes along, and they take Dow's observations, and they make this giant leap from just looking backward to actually looking forward. This is the moment where analysis starts to transform into actual prediction.
Okay, so check this out. William P. Hamilton took Dow's ideas and organized them using these really cool oceanic metaphors. He said the tide is the huge long-term trend of the market. The waves, those are the shorter swings that happen within that big trend. And the ripples, that's just the daily noise, the stuff you should probably just ignore. What a simple, elegant way to bring some clarity to all that market chaos, right? And this wasn't just some abstract theory he was playing with. Oh no. Hamilton put his ideas to the ultimate test. On October 21st, 1929, he sent out this urgent warning. A crash is coming. And just 3 days later, the market completely collapsed. His theory had proven its predictive power in, well, about the most dramatic way you could possibly imagine. So, okay, the theory worked, but the next big question was, how do you make it profitable? That's where a guy named Robert Rhea steps in. He's the one who took this framework and turned it into a practical, actionable tool that could tell traders when to buy and when to sell. He even published an investment letter that, get this, made its subscribers an absolute fortune by calling the market bottom in 1932 and the absolute top in 1937.
So now that the theory is in place, the next wave of pioneers came along, and they really focused on perfecting the visual side of all this, the charts themselves. These are the artists of analysis.
And there was maybe no one better at it than Edson Gould. I mean, this guy's track record was just unbelievably long and accurate. We're talking stunningly precise calls for over half a century, and you can bet his skills were in high demand. People paid a lot of money for his investment newsletter. His accuracy was it was almost spooky. Take this number, 1,040. So in the early 70s, the market was stuck below this huge psychological barrier. But Gould, he confidently predicted that Dow would finally break through. And in 1973, it hit his target. Exactly.
But he wasn't done. Nope. In 1979, while almost everyone else was still obsessed with that 1,000 level, Gould made an even bolder call. He said the Dow would eventually hit 3,000. He passed away in 1987, but just 4 years later, in 1991, his prediction came true. A final, correct call from beyond the grave.
Now, our final master of the chart is John Magee, a man who pretty much wrote the Bible on this whole subject. His 1948 book, Technical Analysis of Stock Trends, is still considered a cornerstone of the field, even today.
Oh, Magee was a total purist. He believed that everything you needed to know was already right there in the chart. He identified all those classic patterns we still use, like triangles, flags, and of course, the famous head and shoulders pattern. He believed these shapes revealed the hidden psychology of buyers and sellers, and to keep his analysis pure, he famously refused to even read a newspaper. He thought that outside news would just corrupt the clean signals he was getting from his charts. Now that is some serious discipline.
Okay, so right about now, some of you might be wondering about a few other famous names. You're thinking, hey, what about Jesse Livermore, or R.N. Elliott, or W.D. Gahn? So why aren't they on this list? Well, the source material argues that while they're fascinating figures, they kind of represent a different branch of market theory, not the direct lineage that we've been tracing here.
Let's break down the reasoning. The pioneers we've talked about all built on each other's work, right? They left behind practical, testable frameworks and a very clear, documented legacy. On the other hand, you have someone like Livermore, a brilliant trader no doubt, but he didn't leave much theory behind and, sadly, died broke. And as for Elliott and Gahn, their theories are considered really difficult to test and trade, and while there were rumors they were successful, there's just no solid record of their fortunes like there is for the others.
So the big question is, why does the work of these guys, done decades and decades ago, still matter in our modern, high-speed, algorithmic markets?
At the end of the day, their legacy is just baked into the very language we use for investing. I mean, every single time an investor, it doesn't matter if they're a technical purist or a hardcore fundamental analyst, every time they talk about getting in low or timing the market or picking the right entry and exit points, they are paying homage to these men. They're using the techniques and the very foundation that these guys built.
I mean, these men built the foundation that generations and generations of traders have been standing on ever since. And it leaves us with a really fascinating question for the future, doesn't it? In this new age of AI and quantitative analysis, whose shoulders will the next generation of market pioneers stand on?